Between 2001 and 2013, more than $4 billion in drug cartel revenue passed through major financial institutions in New York, London, and Geneva. The money moved through correspondent accounts, real estate investments, shipping insurance policies, and structured bond purchases. Every transaction cleared compliance review. Every document met regulatory standards. Every wire transfer was approved by licensed financial officers. Law enforcement traced cocaine shipments from Colombia to California. Intelligence agencies monitored cartel communications across 3 continents. Regulatory bodies flagged thousands of suspicious transactions. But one man operated at the center of the system for over a decade, without detection. He held dual citizenship. He trained in Swiss private banking. He built corporate structures across 7 jurisdictions, and he understood something that most criminals did not. The financial system was not designed to stop him. It was designed to process volume. To investigators, he had no name. He appeared in no indictments. He exists only in the architecture he left behind. A network of shell companies, correspondent relationships, and liquidated accounts that moved nearly $5 billion before anyone understood what had happened. This is the story of how one financial technician exploited the gap between compliance and enforcement, and why the system that should have stopped him instead made his work possible. After September 11, 2001, the United States restructured its financial surveillance apparatus. The USA Patriot Act expanded the Treasury Department's authority to monitor international transactions. The Office of Foreign Assets Control maintained lists of sanctioned individuals and entities. Banks were required to implement anti-money laundering programs with dedicated compliance officers, transaction monitoring systems, and know-your-customer protocols. On paper, the reforms were comprehensive. In practice, they created a compliance industry, not an enforcement mechanism. Banks hired thousands of compliance staff. They purchased monitoring software. They filed millions of suspicious activity reports with the Financial Crimes Enforcement Network. But the system was designed to document risk, not eliminate it. A filed SR satisfied regulatory requirements, regardless of whether anyone acted on the information. The man who would exploit this gap understood the distinction precisely. His name does not appear in any public record. Court documents refer to him only through corporate entities. Law enforcement sources interviewed for this account described him as a financial architect, a technician who designed systems rather than executed transactions. He was born in the early 1960s, held passports from 2 European countries, and completed his banking training in Geneva during the late 1980s. His specialty was offshore account structuring for high-net-worth clients seeking tax efficiency and privacy. By 1995, he had established independent operations in Panama City. His initial clients were legitimate: European industrialists, Latin American landowners, Middle Eastern merchants seeking dollar-denominated assets. He built holding companies in Panama, investment vehicles in Curaçao, and management entities in Switzerland. Each structure had real operations: shipping logistics, commercial real estate, agricultural commodities trading. The companies employed staff. They filed tax returns. They maintained audited financial statements. From the outside, they appeared to be what they claimed: multinational business operations serving wealthy clients. The transition to illicit finance occurred gradually. In 1998, the banker was introduced to a Colombian businessman through a mutual contact in Panama. The businessman represented agricultural interests in the Cauca Valley, a region known for both coffee production and cocaine processing. The initial request was modest: help moving $2 million in profits from agricultural exports to a Swiss account. The documentation was clean. The funds appeared legitimate. The banker processed the transaction. Over the following months, the volume increased. The documentation remained consistent. invoices for coffee, shipping manifests, insurance certificates, but the amounts grew disproportionate to the stated business activity. The banker recognized the pattern. He also recognized the opportunity. Rather than withdraw, he restructured. He created a layered system of corporate entities designed to absorb large cash volumes while maintaining documentary legitimacy. At the base were money services businesses in Colombia and Mexico, licensed currency exchanges that converted pesos and physical dollars into wire transfers. These transfers moved to holding companies in Panama, which invested the funds in real assets, shipping containers, warehouse facilities, residential developments. The real assets generated legitimate income. That income was then transferred to investment vehicles in Curaçao, which purchased financial instruments through correspondent accounts at major banks in New York and London. By the time the money reached Wall Street, it had been transformed. It was no longer drug cash. It was investment capital from a Caribbean fund with audited financials and a decade-long track record. The banker had not hidden the money. He had legitimized it. The first significant deposit entered the U.S. banking system in March 2002. A Curaçao-registered investment vehicle transferred $8.4 million to a correspondent account at a major New York bank. The stated purpose was the purchase of municipal bonds. The documentation included audited financials, beneficial ownership declarations, and a compliance certification from a licensed administrator in the Netherlands Antilles. The transaction was reviewed by a junior compliance analyst. It was flagged for enhanced due diligence based on the jurisdiction of origin. The analyst requested additional documentation. The banker's team provided everything requested within 48 hours. Corporate registry filings, board resolutions authorizing the investment, and a letter from a Swiss law firm confirming the legitimacy of the underlying funds. The transaction was approved. Over the following 18 months, the same entity executed 147 similar transactions totaling $312 million. Each was documented. Each was reviewed. Each was approved. The compliance system functioned exactly as designed. It processed paperwork. It did not investigate substance. Internal bank communications obtained during later congressional investigations revealed the institutional dynamics at play. Compliance officers who raised concerns about high-volume clients were routinely overruled by relationship managers focused on revenue targets. A 2004 email from a senior vice president at one institution stated explicitly, "We cannot decline business from documented clients based on suspicion alone." The banker exploited this tension deliberately. His entities were always documented. His transactions were always supported by paperwork. His beneficial ownership structures were complex but technically compliant. Compliance officers who reviewed his accounts found no clear violations, only patterns that suggested further inquiry might be warranted. Further inquiry required resources. Resources required justification. Justification required evidence. Evidence required investigation. Investigation required time that compliance departments did not have. The volume was simply too high. By 2005, the banker's network was processing approximately $40 million per month through U.S. correspondent accounts. The transactions were distributed across multiple entities, multiple banks, and multiple asset classes. No single institution saw the full picture. Each saw only its portion of a fragmented whole. In 2006, a compliance officer at a mid-tier investment bank filed a suspicious activity report on one of the banker's affiliated entities. The SAR noted unusual patterns in trade execution, matching orders that suggested coordinated activity between nominally independent accounts. The report was transmitted to FinCEN. It was logged. It was categorized. It was closed within 30 days with no follow-up action. The system had registered the anomaly. It had not responded to it. The banker continued operating for another 7 years. The Drug Enforcement Administration first encountered the banker's network in 2007. A routine cash seizure at a border crossing near Laredo, Texas, produced $2.3 million in vacuum-sealed currency. The bills were marked with trace chemicals consistent with cocaine processing. The courier, a Mexican national, provided limited information under interrogation but identified the intended recipient, a logistics company in Panama City. DEA analysts traced the company through corporate registries. It was a subsidiary of a shipping conglomerate that appeared in the banker's network. The connection was circumstantial but significant. The case was referred to the agency's Special Operations Division for further investigation. SOD analysts compiled a preliminary assessment linking the Panama entity to suspected money laundering activity. They requested cooperation from Treasury's Office of Terrorism and Financial Intelligence. The request was denied. Treasury officials cited ongoing compliance reviews at multiple financial institutions that might be compromised by a criminal investigation. The institutions had not been formally accused of wrongdoing. Premature disclosure of investigative interest could trigger legal liability for the government. The DEA investigation stalled. A parallel track emerged at the Central Intelligence Agency. CIA analysts monitoring financial flows in Latin America had identified unusual patterns in offshore investment activity. Funds were moving from Caribbean jurisdictions to U.S. markets in volumes that exceeded the documented economic activity of the originating entities. The patterns suggested either sophisticated tax evasion or money laundering. The analysts prepared a classified assessment recommending interagency coordination with Treasury and Justice. The assessment noted that jurisdictional constraints, particularly banking secrecy laws in Switzerland and Panama, would limit direct investigation but suggested that indirect approaches through cooperating financial institutions might yield results. The assessment was circulated internally. It was not acted upon. A 2010 internal CIA memorandum, later obtained through Freedom of Information requests, summarized the institutional challenge. Subject network demonstrates systemic concealment via infrastructure, not deception. Entities comply with formal requirements while obscuring beneficial ownership through layered structures. Current enforcement framework lacks tools to address compliant concealment. The banker understood this limitation. His meetings with clients took place in Switzerland, Panama, and Dubai, jurisdictions with strong banking secrecy protections. He never used electronic communications for sensitive discussions. He never transmitted documents that could be intercepted. He relied on licensed professionals, lawyers, accountants, fund administrators, to execute transactions, creating layers of attorney-client privilege and professional confidentiality. When he traveled, he carried no electronic devices. He maintained no email accounts. His name appeared on no corporate documents after 2003, when he transferred formal ownership of his entities to a network of nominee directors. To investigators, he existed only as an inference, a pattern in the data that suggested coordination but could not be traced to an individual. The agencies that should have stopped him operated in parallel, not in concert. DEA tracked drugs. Treasury monitored banks. CIA analyzed threats. Justice prosecuted cases. Each had a piece of the picture. None had authority to assemble the whole. The banker operated in the gaps between them. The exposure began with a coincidence. In September 2012, Spanish National Police conducted a raid on a residence outside Marbella, connected to a suspected Mexican cartel affiliate. The target was a mid-level logistics coordinator believed to be managing European distribution for a Sinaloa-linked organization. The raid produced the expected evidence: communications equipment, cash, ledgers documenting drug shipments. But it also produced something unexpected: a folder of corporate documents related to a Cayman Islands registered investment fund. The documents included account statements, wire transfer records, and correspondence with a fund administrator in New York. The fund appeared to be a legitimate investment vehicle, but its transaction patterns matched the methodology the banker had pioneered a decade earlier. Spanish investigators shared the documents with U.S. counterparts through mutual legal assistance treaty channels. The materials reached the Securities and Exchange Commission in early 2013. SEC analysts identified irregularities almost immediately. The Cayman Fund had executed trades through a New York-based hedge fund that specialized in emerging market debt. The trade execution logs showed patterns consistent with wash trading, coordinated buy and sell orders designed to create the appearance of market activity without genuine economic purpose. The hedge fund was subpoenaed for records. What emerged was a web of correspondent relationships linking the Cayman entity to the banker's original network. The same fund administrators appeared in both structures. The same law firms had provided compliance certifications. The same beneficial ownership patterns, layered through multiple jurisdictions, obscured the ultimate source of funds. The SEC referred the matter to the Justice Department for potential criminal investigation. By then, the banker had already moved. His network had detected the Spanish raid within days of its occurrence. The Cartel affiliate who was arrested had indirect knowledge of the fund structure. His capture represented a security breach. The banker initiated liquidation protocols. Over the following 6 months, his entities systematically wound down operations. Investments were sold. Accounts were closed. Corporate structures were dissolved through legal processes in their respective jurisdictions. Assets were transferred to new entities in Singapore, Hong Kong, and the United Arab Emirates. When Justice Department investigators attempted to freeze accounts in early 2014, they found nothing. The funds had been dispersed. The entities no longer existed. The beneficial owners could not be identified. The total volume that had passed through the network over 12 years, $4.8 billion. The amount recovered, 0. The banker was subpoenaed to appear before a federal grand jury in Manhattan. The subpoena was served at his last known address in Geneva. He did not appear. Swiss authorities declined to extradite, citing insufficient evidence of criminal activity under Swiss law. No charges were ever filed. What follows was reconstructed from Treasury Department analysis, Congressional testimony, and confidential interviews with former compliance officers conducted between 2018 and 2022. The banker did not stop. He adapted. Within months of liquidating his original network, he had established new structures in Southeast Asia. The methodology was identical: layered corporate entities, legitimate business operations, compliant documentation, but the geography had shifted to jurisdictions with less developed regulatory cooperation with U.S. authorities. Singapore became the new hub. The city-state offered political stability, sophisticated banking infrastructure, and a legal system that protected client confidentiality while maintaining sufficient international legitimacy to avoid blacklisting. The banker registered a family office there in late 2014, nominally managing investments for unnamed high-net-worth individuals. The family office made its first significant U.S. investment in 2015, a $12 million stake in a commercial real estate development in Miami. The investment was structured through a Delaware limited liability company with no public disclosure requirements for beneficial ownership. The funds originated from a Hong Kong account held by a British Virgin Islands entity that had received transfers from the Singapore family office. Each step was documented. Each entity was registered in a compliant jurisdiction. Each transaction met the formal requirements of every regulatory system it touched. Miami was not a random choice. The South Florida real estate market had become a preferred destination for international capital seeking dollar-denominated assets. Purchase prices were high. Cash transactions were common, and the beneficial ownership of real estate investments was effectively opaque under U.S. law. Between 2015 and 2019, entities linked to the banker's new network acquired more than $340 million in South Florida, commercial and residential properties. The purchases were financed through a combination of offshore capital and domestic lending. The properties generated rental income that was reported, taxed, and recycled into additional investments. The money had completed its transformation. It was now American real estate equity. Treasury analysts identified the pattern in 2020 during a routine review of foreign investment in U.S. real estate. The corporate structures bore unmistakable similarities to the original network. The same layering methodology, the same jurisdictional selection, the same documentation practices. But similarity was not evidence. The entities were different. The beneficial owners were different. The transactions were compliant. An internal Treasury memorandum from that year noted the limitation. Current regulatory framework permits compliant concealment of beneficial ownership in real estate transactions. Without mandatory disclosure requirements, enforcement agencies cannot distinguish legitimate foreign investment from laundered proceeds. The Corporate Transparency Act, passed in 2021, was designed to address this gap by requiring disclosure of beneficial ownership for most U.S. entities. Implementation was delayed. Enforcement mechanisms remained undeveloped. The banker's second network continued operating. His original methodology had been replicated by others as well. The 2012 document leak had exposed his techniques to both law enforcement and criminal competitors. Within 2 years, similar structures were appearing across multiple jurisdictions operated by individuals with no connection to the original network. The blueprint had proliferated. By 2020, analysts estimated that variants of the banker's methodology were processing between $8 billion and $15 billion annually through U.S. financial markets. The funds originated from drug trafficking, human smuggling, sanctions evasion, and tax fraud. They entered the banking system as compliant investments and emerged as legitimate assets. The system had not failed. It had been optimized by the people it was supposed to stop. The congressional hearings began in March 2014. The Senate Permanent Subcommittee on Investigations had compiled a 400-page report documenting failures in anti-money laundering enforcement at major U.S. financial institutions. The report focused on 2 banks that had processed billions in suspicious transactions from Mexican and Colombian sources. The hearings produced dramatic moments. Bank executives admitted under oath that compliance concerns had been subordinated to revenue priorities. Internal communications revealed that relationship managers had dismissed money laundering warnings as paranoid and bad for business. Compliance officers testified that they had been instructed to approve transactions they believed were illegal. The consequences were financial, not criminal. Both banks entered deferred prosecution agreements with the Justice Department. They paid fines totaling $1.9 billion. They agreed to enhanced monitoring and compliance reforms. No individual executive was charged. No banker went to prison. The pattern repeated across the industry. Between 2012 and 2020, U.S. and European regulators imposed more than $36 billion in fines on financial institutions for money laundering violations. The fines represented a fraction of the profits generated by the underlying activity. They were absorbed as a cost of doing business. The structural incentives remained unchanged. Banks earned fees on every transaction they processed. Compliance departments were cost centers that generated no revenue. Relationship managers were compensated based on client, assets, and transaction volume. The institutional pressure was always toward approval, not rejection. The banker had understood this from the beginning. His success was not based on deception, it was based on exploitation. He gave banks what they needed: documentation, compliance certifications, plausible explanations, and they gave him what he needed: access to the global financial system. The system that should have stopped him had instead enabled him, and after he was exposed, it enabled his successors. New laundering methodologies emerged to exploit new technologies. Cryptocurrency offered pseudonymous transactions that could be layered through multiple wallets before conversion to traditional currency. Decentralized finance platforms provided lending and trading services without the compliance requirements of regulated institutions. Private equity funds accepted investor capital with minimal due diligence. Each innovation created new gaps. Each gap was exploited before regulators understood it existed. A 2022 Treasury Department assessment estimated that less than 1% of global money laundering activity resulted in successful prosecution. The remaining 99% moved through the financial system unimpeded, documented, compliant, and invisible. The banker had been a pioneer. He was no longer an exception. As of 2025, the man at the center of this account has never been charged with any crime. His name has never appeared in any indictment, any regulatory filing, or any public document. He exists in the investigative record only as an inference, a pattern in transaction data, a signature in corporate structures, a methodology that spread far beyond his original network. To the compliance officers who reviewed his accounts, he was a legitimate client. To the regulators who examined his transactions, he was compliant. To the prosecutors who sought to charge him, he was beyond reach. His success was not in evading the system, it was in understanding it. He recognized that modern financial regulation is built on documentation, not investigation. That compliance departments process volume, not risk. That interagency coordination fails when jurisdictions conflict. That criminal prosecution requires evidence that sophisticated structuring makes impossible to obtain. He did not break the rules. He operated precisely within them, exploiting the gap between what the rules required and what they achieved. The $4.8 billion his original network processed represented cocaine profits, cartel revenue, the proceeds of violence and addiction. That money is now embedded in the global economy as real estate equity, investment returns, and legitimate business capital. It cannot be recovered. It cannot be traced. It has been transformed. The system worked exactly as it was structured to work. That was the problem.